Pathik Gandotra joins us, partner with Dron Capital. He joins us live from our Mumbai studio. Pathik, morning. Thank you for joining us. Pathik, I guess it's easy to understand the market environment. We've got 10-15 stocks which are holding on. That's quality FMCG, quality IT and quality pharma. That's about it. Rest of the market is not doing anything special.
Yeah, so obviously in any rally it has to be led by a few leaders. So I think given the fact that on the rest of the economy or cyclicals there are headwinds because of the rupee and because of the RBI action and a slowdown which is still ongoing, I think when liquidity comes into the markets, it finds the sectors which are going to be in a long-term fundamental bullish uptrend. So IT obviously is very much there because the US economy, for whatever it is showing signs of some incipient recovery. And so you would tend to think that dollar revenue growth of these companies will only improve going forward from here on. And so I think that's where the money is flowing through. And that's where actually the reallocation is happening towards IT.
So Pathik, if one has missed the recent rally in IT ever since Infi came out with its earnings, what does one look out to buy right now?
I mean, actually, at one level, almost anything, because mid-cap IT stocks will do very well from here on, because we believe that as the economy in the US improves, discretionary spends will start improving. And if you look at the way the commentary from even TCS is, they're also saying that discretionary spends are improving. So once discretionary spends start improving, the mid-cap IT space actually picks up radically. Everybody has a different business plan. So I think there are plenty of good stocks and good management. So I don't want to name any stocks, but the issue is whatever stock which has a good management in the mid-cap IT space is one should latch on.
Pathik, but it's quite ironical that the IT index is at a record high. Rupee has depreciated by about 10% plus in last 3 months. And mid-cap stocks or mid-cap IT stocks have not participated. If I look at Mindtree, Geometric, Hexaware, Persistent, mid-cap IT stocks are languishing.
So that's where the opportunity is, right? Because the large cap has done well. If the large cap valuations stick, mid cap will sooner or later participate. I think people are waiting for their earnings. I mean, if you have good, say, KPIT, for example, is reporting today. If you have good numbers coming out from that stock, then you have to get a flavor of mid cap IT earnings. Once you have a fix on those earnings, or if they deliver 1 quarter of very good earnings, then they will join the party.
Mid-cap IT is a very large space. So what is on your radar when it comes to mid-cap IT space?
So, I mean, almost, you can look at a company like KPIT, you can look at a company like Tech Mahindra, if you want to call it mid-cap. I mean, it's largish cap. These two stocks, I think, look pretty good.
What is the story for KPIT? Because my understanding is that the automobile revenue for KPIT, which has been a differentiator, could now come under stress.
Why should it come under stress?
Well, given what's happening to the global automobile industry, Detroit has filed for bankruptcy.
No, that's not the point. The point is that the component of electronics in a car is going up, and that's a secular trend that is taking place. And that trend, that trend is an irreversible kind of trend, and that's what is leading to their revenue growth. And that's a part of their business. There's also a big business beyond that. I mean, I'm no IT analyst, but I can just tell you that, I mean, as a space, a company which defines a niche, I think normally does better than a broad-based company.
Okay, fair point, Pathik. Let's chat about banking then. Do you think we'll have to live with the asset quality concerns? Meantime, will we continue to see some trading moves when it comes to the bank nifty, which was so pressured up until last week? But ever since yesterday, I should say, we've been seeing some good short covering led rally.
Yeah, see, the point with the bank nifty is very clear. The issue is that your economy is threatening to, kind of sink into relapse, and which is what is hitting the concerns around asset quality. I don't subscribe to that view. So my view is that it's a long process of bottoming out that you will go through. And with each correction, the government is doing something which is seriously reformist. For example, now they have fast-tracked all of infra projects, which nobody seems to be talking about right now, because that is not where the attention of the market is right now. Market is more interested in what the government is doing on the rupee. But beside that, they have really fast-tracked infra projects, and you can actually get the feeling from the grapevine that the action has started to show in the project. So I think government is doing something about trying to at least prime the economy through whatever it can. I mean, because earlier if you notice, 6 months back people were saying that what's the point in cutting interest rates when the government policy is a hindrance. So now government policy is working into your favor. Interest rates are a temporary hindrance till the rupee stabilizes. Eventually I think interest rates in India are going to fall over the next 12 to 18 months. So then you realize that government has already done so much on around the implementation of projects, and then I think you will see a path of recovery.
Pathik, what have you made of the recent move by the RBI to curb gold imports yet again? Do you think it's far too little, too late?
No, I don't think so. I think what it is telling me that they will not use monetary policy anymore to suppress the rupee, to control the rupee, or the issue is they are going to do everything else other than controlling it through monetary policy, because monetary policy is not working in a slowing economy. A tightening monetary policy does not work in a slowing economy. It is counterproductive to the rupee. So they have already seen in the first move they have realized what sort of effect it can have, because government bond yields shot up, mutual funds were starved of liquidity for a day, then RBI had to itself correct the whole liquidity situation, and so it realized that that's a counterproductive move. So the thing is, RBI and the government will use everything other than monetary policy to control, to rein in the rupee.
Let's look at ICICI Bank. This is one stock we've discussed with you on this forum itself. You've been hot on ICICI Bank. Numbers are not bad. Bank is still growing. NIMs are expanding. Asset quality is well under check. But the stock is not moving.
Yeah, because there's a looming specter of asset quality on its on the power exposure in banks and on the infrastructure exposure in banks. Now ICICI Bank may not be in the exposure to size. I mean, its exposure is much more limited than the rest of the state-owned banks. But the point is, I mean, as the whole sector is under a derating, going through a derating, a stock by itself, which is so large and so linked to the economy, cannot outperform. So I think that's the problem there.
I think we can talk about expensive valuations, frothy P multiples for FMCG and some consumer names. But the bottom line here is that for those who bought expensive FMCG names and stretched valuations in some of the pharma names, they've made money. How does one figure out that this trade will continue or this trade is about to end?
Honestly, you cannot figure out. The only time you will figure out is when you actually see the economy rebounding seriously and interest coming back into domestic cyclicals. Till then, I think the trade on FMCG and pharma and IIT will continue. IT is independent. FMCG, pharma will continue, because first of all, they will benefit first, because if an economy starts growing, it will show in consumer demand as well, and so there will be even a further re-rating. But eventually, as cyclicals catch up, you will see these things starting to underperform domestic cyclicals. I don't think, and I've never believed that FMCG in stocks will go through an absolute price correction. I mean, it can only be sideways, and it can be underperformance, not absolute declines.
Pathik, in light of L&T's earnings yesterday, would cap goods be an avoid?
Cap goods, avoid or not avoid, is not linked to L&T's earnings, because L&T's earnings are a reflection of what's happening in the economy. And having said that, actually I'm not so negative on L&T's earnings, because they have said that they're maintaining the guidance for the year. It's just that in the current environment, an earnings miss by 4 to 5% gets punished disproportionately, which is what has happened with L&T. I mean, it's not as if they've stopped growing at all. I mean, the issue is there's an issue. They have said that it's a quarter to quarter issue, and so you might then find them surprising next quarter, and you'll say suddenly the economy is recovering. I don't think one should read too much into it. I mean, it's obviously earnings are bad. There's been a margin compression, and so stocks has reacted, but I would not take that as a long-term view on all capital goods stocks. Each one is an independent thing. You would normally try to avoid capital goods stocks in an economy till it shows some signs of life. So it's not linked to L&T's earnings.
But some of the brokerages are also of the view that is L&T being slightly optimistic when it comes to their FY14 guidance. I mean, they're talking about numbers of double-digit margins and 20% growth. And on the other side, they are admitting that the business environment is not challenging. So they are talking something else and they're doing something else.
This is typical of a time when the economy has to go through a turn. Or it's at a point of a decision. So either it relapses and then we go into negative growth or on GDP industry or IIP, or it picks up and then you start seeing positive growth. So you can always take inputs and your empirical evidence from both sides. So, at that point in time, you will obviously find dichotomy in between what the analysts and the management speak. Sometimes you might find the management being much more pessimistic than what the analysts are. But, I mean, these things happen. So all I'm saying is, you're not going anywhere in the next few months. Eventually, by the end of the year, I think the economy should recover and then the commodity should turn bullish.
Pathik, I just want to come back to the point that you were making, which was quite interesting, as in the RBI's latest move to curb gold imports. What it does tell us is that come this policy, and we will definitely not see a cut in interest rates, if not a hike. Is that something that the market as well as priced in, or come policy day and we will still see a knee-jerk reaction of 1 to 2% on the market?
No, hang on. The market is not pricing in a cut at all. There's no talk of any cut. I'm just saying the market was worried last week about a possible CRR hike because the rupee did not respond enough to the RBI citing measure. So the step forward, they'll go and do something even more to arrest the rupee. That is what was the view on the market, which is why banking stocks collapsed last week. The point is, what this action is telling us is that they want to do everything else other than tightening monetary policy. So what will happen from RBI this quarter, this monetary policy will be status quo. No change in CRR, no change in interest rates, and they will maintain their commentary.
Okay. Let's look at Mahindra and Mahindra Finance, 271, 272. Bajaj Finserv has also appreciated. Pathik, are you a buyer in NBFC stocks? Because NBFCs are a direct beneficiary of rural demand. Yes, in the short term, markets are worried about wholesale borrowing cost moving up, but in the past, some of these quality NBFCs have managed to weather the storm.
So I would buy them on declines. I would not buy them on a day like this when stuff has gone up 4-5%. So we would have bought Mahindra and Mahindra Finance when the stock had collapsed, because the fact that it had mentioned on its earnings call that it would not go and become a bank. So on a day like that, one would go and actually buy the stock, but not on a day like this. See, the issue is there's no point in chasing financials at all. I mean, you will get your price. Although I think that a big bottoming out process is on in PSU banks and in private banks as well. And so if anybody who buys over the next 2 to 3 months will actually make significant amount of money over the next 2 to 3 years. So it's a very good time to buy. But the point is, one should not chase stocks.
So what is, give me a profile of existing portfolio. How much of beta you own, how much defensives are you exposed to, what are you buying when it comes to exporters, and how exactly are you betting on when it comes to cyclicals? So
we are equally exposed on consumers, pharma and IT in equal proportions, and we've started buying into select financials. But the private banks and NBFCs.
So what do you like from the private banking space? Do you like large names like ICICI Bank, or are you ready to go down the ladder now? And are you nibbling at, let's say, a Federal Bank or a Karur Vysya Bank?
No, so we don't buy old privates. I would buy amongst the new private sector banks. So what we would look at is probably an IndusInd Bank. I'm not saying what I own, but I'm just saying what I would look at is an IndusInd Bank, a Yes Bank, an ING Vysya Bank. These are stocks which are trading at fairly attractive valuations vis-a-vis their own growth and ROE perspective. So I would look at these stocks right now to buy rather than buying NBFCs right now. HDFC, I think, is obviously very attractively priced now, given the fact that it is trading at about just 2.7, 2.8 times net of its gains. I mean, HDFC normally bottoms out between 2.5 to 3 times, and unless it's a crisis situation. It is not a crisis situation. So this kind of valuations for HDFC are also pretty attractive, and we would buy HDFC.
Pathik, really good chatting with you. Appreciate you taking the time out and joining us today on the show.